It's finally here, Nvidia after the bell, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Wall Street gears up for Nvidia. The world's most valuable company takes the earnings spotlight after the bell. And President Trump imposes a crushing 50% tariff on Indian goods while Europe seeks to remove all tariffs on U.S. industrial goods this week. Plus, another full bag of retail results, back-to-school demand, and celebrity partnerships helping boost the bottom line. But Katie, there is one stock to watch today.
Only one stock to watch today. You guessed it. It's Nvidia. Nvidia priced to move 6% in either direction after earnings today. That's according to a look at the option market. Now, that is the lowest implied move in about 2 years as traders focus on the staying power of the AI boom. And of course, China sales have taken on new levels of complexity, with 15% of revenue for chips sold in China going to the U.S. government. You see shares not moving around too much right now, Matt. We know that the main event is after the close.
Yeah, absolutely looking forward to Romaine and crew breaking those numbers. We're also watching shares of the other Mag 7 stocks. Meta, Microsoft, Alphabet, and Amazon are the big four. They account for 40% of Nvidia's revenue. You can see there's pretty little change here. I mean, up 0.4, down 0.3, but these are the stocks along with Nvidia that really move the market. These four stocks make up 15% of the S&P 500's total market weighting.
All right, for more on Nvidia earnings, I'm pleased to say we're joined now by Bloomberg Tech co-host Caroline Hyde and Mandeep Singh. He is global head of tech research for Bloomberg Intelligence. So important that we decided to do a roundtable. So, Caroline, let me start with you. Obviously, I can't imagine that you'll be talking about anything else on Bloomberg Tech today. What is the expectation heading into these results? You take a look at the options market. 6% isn't nothing, but it's certainly not the fireworks in the past.
But it's potential big swings and big market impact when you've got a $4.4 trillion company and the most valuable. And as you've just been insinuating, it will affect a lot of other companies. But there's also a big divergence in the highest of the highs and the lowest of the lows when you look at analyst expectations for revenue. And Mandeep can speak to what his expectations are. But when you're looking across the board, ironically, the only sell rating on Nvidia is actually the highest expectation for the revenue number, in excess of $50 billion. I'm talking about $52 billion are expected over at Seaport. But then the lowest is about $15 billion under that. And the real discrepancy here is whether you're factoring in the Chinese revenues or not, whether you're seeing any H20 sales whatsoever, or whether you're thinking that's off the table for now. What do we hear in terms of Chinese actual demand? I think a really interesting tell today was some earnings we got out of China. Capricorn is one of a key AI accelerator developer over in China. They're against SMIC and the like, and Huawei, and they've seen incredible growth in their market cap and their revenues. So China's trying to pull away from the likes of Nvidia. What is the longer term perception of Jensen on that? That's going to be a big volatility gauge. But actually, a lot of analysts and investors I speak to say, in the longer term, doesn't matter. This is a demand supply issue. This is not a demand issue.
How important, Mandeep, are China sales to this final number today? And, you know, every time China comes out and tells its companies not to buy the H20 chips, we act like it's a new story. But they've been saying this all year long, right? They issued a directive, I think in March, that they didn't want their companies buying Nvidia's H20 chips. So are they going to have bought them this quarter?
So when Nvidia reported last time, they actually took a $8 billion write-down for this quarter. The reason why the estimates are somewhat lower, 45 to 46 billion for this quarter, is because they took a $8 billion write-down on H20s. So clearly, the estimates have been de-risked from a China exposure standpoint. With that being said, if Nvidia is able to sell back to China, whether it's the new Blackwell B30s or some other version, then that means there's upside to 3Q. And that is where, you know, the bogey that at least the consensus numbers are there. Probably, I would say it should be 2 to 3 billion higher than what the consensus is for next quarter, which is around 53 billion.
How do you approach the question of what Chinese sales will look like, though? I mean, you take a look at our Bloomberg News reporting, there's a $15 billion range for third quarter revenue projections. You have the likes of Susquehanna saying that they're refusing to put sales of H20 chips into their models. That seems hard to do, but at the same time, it's just hard to know here.
So if you're in Nvidia right now and you don't have a lot of visibility with the Chinese customers, and you have limited capacity with TSMC to make those chips, you're probably not going to make H20s or B30s. You're going to make other chips that the sovereigns can buy. And so from that perspective, actually, it could be a positive for the gross margins if you're not selling H20s or B30s. So I think if Nvidia is planning, for the next 3-4 quarters, given the uncertainty, they'll try to downplay the China exposure and focus more on the sovereigns. And really, I do think that should help the margins.
What about the big four that you and Ed cover on Bloomberg Tech so closely, right? They make up a huge chunk of Nvidia's revenue, these hyperscalers on the West Coast, and they've all announced their CapEx already. So we essentially know, is that spending baked into today's number? And what's the risk that they're spending too much and they won't be spending more in the future?
It's interesting. We had Beth Kidrig on the show yesterday, IO Fund, and she's actually, ahead of many, seen what the overall appetite for data center spend and capital expenditure is going to be. She's saying, look, we're only going up and to the right. She foresees Nvidia becoming a $6 trillion company on the back of just the Blackwell architecture. Rubin, she's seeing like a $10 trillion company because of the sheer size of the capital expenditure that is going to keep on coming from hyperscalers, but then others around as well. This is going to spread out, as you say, sovereigns become a big area of demand. And so I think it's more about what's forecast and what's baked in there. We kind of had a tell. And actually, we saw Alphabet and many others raise their capital expenditure forecasts. So people, particularly analysts, at least 9 of them last week, upgraded their forecasts for Nvidia. People are getting more and more excited about what the numbers they're going to post.
But the risk is, I think one risk is indigestion, right? I mean, if they bite off more than they can chew this year, then next year that will slow down a little bit, right? We've seen overinvestment in the past when you were laying fiber for the internet in 1999 and 2000.
On that point, so this year, the CapEx from the hyperscalers is growing north of 50%, and NVIDIA's revenue is growing almost 60% data center side. Next year, Meta and all the others have said it's going to be over $100 billion in CapEx. So for Meta, it translates to over 30% growth. For Alphabet and Microsoft, anything over $100 billion could mean 10 to 15% growth, or it could be higher, but we don't know exactly what it's going to be. So it really matters whether all the hyperscalers in aggregate grow their CapEx 25 to 30%, or the aggregate number is below 20%, and that will have a bearing on NVIDIA's growth for next year.
And I mean, Mandeep's been so articulate about the issue of whether it's all about training your models or whether it's moved to inference, and Jensen's spoken a lot about that. But Matt, to your point, if you go into the EM function for NVIDIA on the Bloomberg terminal, we are forecasting a significant slowdown in revenue growth. Look, this was a company that was growing revenues more than 250% last year. We're now expecting for the full year about 56%. Then it slows down to about 28%. Then it slows down to about 15%. These are gargantuan numbers, but they are going to start slowing in the pace of absolute growth.
All right, yeah, and we'll see, of course, how investors digest that. It is interesting that you take a look at NVIDIA's valuations, and it's cheaper, less expensive than it has been, but still some eye-watering levels there. Great roundtable to set us up. That is Caroline Hyde of Bloomberg Tech. You can catch her at 11 a.m. Eastern. And, of course, Mandeep Singh of Bloomberg Intelligence. I imagine you'll see these two faces all over Bloomberg Television today. But let's get to what else is going on in the market. And believe it or not, there's things other than NVIDIA reporting today. We start with Kohl's boosting its sales outlook for the year as turnaround efforts gain a little bit of traction. You can see shares skyrocketing higher, up nearly 21% pre-market. This is a stock that has a pretty hefty short interest, though, Matt.
Yeah, and we're going to be following all of these a little bit later on the program. We're going to talk to Mary Ross-Gilbert from Bloomberg Intelligence about all of these retailers. PVH is a company that owns Calvin Klein and Tommy Hilfiger. It's raised its outlook thanks to celebrity partnerships and collaborations with the F1 film, which most of our team went to.
Yeah, I know that you were among them.
Yeah, you were not. Did you see, by the way, F1 eventually?
Do you think that I did?
Of course
no,
not.
I didn't. But it got rave reviews from the open interest team.
It wasn't that good.
Let's quickly talk about J.M. Smucker falling after sales decreased for coffee, dog snacks, and sweet baked goods, and also fruit spreads. That's a lot of bad news. Shares down about
Coffee,
5%.
dog snacks?
Coffee, dog
Coffee,
snacks.
comma,
Dog snacks. They also have cat food as well. I
Have
believe
you
they
played,
have meal mix.
what is it called? Taco Cat Go Cheese Pizza?
You know, I haven't.
It's a fantastic card game. I recommend you check it out.
Interesting.
Especially fun if you're under the age of like 9.
Yeah.
Let's check on what's going on with futures this morning. Not a lot, right? Ahead of Nvidia earnings after the bell. I didn't see much movement last time I checked. And I don't see much movement now.
No, but you know, everything will change after the close today. It's really the cash session today that's the boring part. It's everything after the market that happens. And we'll see. I mean, Nvidia has an 8% weighting in the S&P 500. So we'll have to see what happens in the after-hours session. The NASDAQ 100 also in a holding pattern, down about 0.1%. The Russell 2000s, the small caps, of course, really being the most volatile area of the market, the pre-market, that is. The Russell 2000 off by about 0.4%, Matt.
All right, coming up, the EU looks set to propose cutting its tariffs on the U.S. to meet President Trump's demands and get its flat 15% rate. We'll give you your global trade update next. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. The gold mining giant Newmont is studying plans to slash costs that may lead to deep job cuts. This follows its $15 billion acquisition of Newcrest Mining in 2023. Newmont has told managers it wants to be closer in line with its lowest cost peers. That would mean lowering costs by 20%. You can see shares in Newmont Mining down 0.4% in the pre-market. Cracker Barrel Old Country Store said it is getting rid of that new logo that no one liked and prompted a huge slump in its share price. Cracker Barrel had faced backlash on social media and from the President of the United States of America after it changed its vintage logo by removing an image of a man leaning against a barrel while making the lettering more modern. In a statement, the company said, "Our old timer will remain." It was pushed yesterday by Donald Trump on Truth Social. Williams-Sonoma is out with earnings. The kitchen and home goods retailer is boosting its full-year forecast. The company is keeping a close eye on tariffs. President Trump said he's thinking about putting tariffs on furniture, and that would impact some Williams-Sonoma brands like West Elm and Pottery Barn. So Williams-Sonoma shares up 1 2/3%, Katie.
All right, keeping a close eye on tariffs. That's what we're doing, too, because sources tell Bloomberg that the EU will propose removing U.S. tariffs on industrial goods this week. Let's get more detail from Bloomberg's Brendan Murray, who leads our global trade coverage. So potentially removing tariffs on U.S. industrial goods, also potentially giving preferential tariff rates on certain seafood and agricultural goods as well. Brendan, what is the calculus here? What does the EU hope to get in return?
Well, this is all part of the framework that the U.S. and the EU agreed to a week or two ago. They're trying to put this in place as soon as they possibly can in Brussels because, as President Trump showed earlier this week, he can throw something like his opposition to the digital regulation and taxation that goes on in Europe. He can throw that into the discussion. So they're trying to push this through the legislative process to get it sort of ratified, to follow through on what they promised the U.S. that they would do. In return, the U.S. will lower the auto tariffs on European exports to the U.S. from 27.5% down to 15%. So the Europeans really think that time is the clock is ticking against them here, and that they need to do this quickly so that they can get some follow through from the U.S. on what's been agreed to in this trade agreement.
Brendan, it's interesting to see the EU concede on tariffs on industrial goods, and yet they push back so hard on these digital tariffs that the president is so unhappy about. He's called them unfair. He's been railing against them for quite a long time. How do they reconcile those two things? And do they face a backlash over the digital stuff?
Well, they drew a red line around the digital services regulation and said that that's our sovereign right to regulate these industries. And effectively, we're talking about Google and Meta and Amazon and the big U.S. e-commerce and social media companies that. The Europeans said, look, we're not going to touch that. And when they got that issue, that it wasn't addressed in the framework agreement, they took that as a victory. But President Trump is still pushing against that. So I think what it suggests is these negotiations are never really going to end in the near term, that President Trump will raise this stuff with the Europeans or with the Koreans or the Japanese. These contentious issues are really never going to go away, and he's going to pull them out when he feels like he can use them as leverage.
But still signs of progress when it comes to the EU-US relationship. A different story unfolding when it comes to our relationship, the U.S. relationship with India, because as of 12:01 a.m. Washington time, there's a 50% tariff on Indian goods here. Brendan, what do we know so far?
Yeah, this is the highest rate in across Asia. It's really going to put Indian exporters at a disadvantage compared to some of their neighbors whose exports are subject to a tariff of something around 20%. So we'll see how much the pain threshold is for the Modi government to sit back and watch their export industries take this one on the chin. That Modi is traveling to Japan and to China in the next couple of days to perhaps shore up some of those relationships, improve those if the trading alliance with the U.S. is deteriorating. So it's just a matter of time before that 50% tariff really starts to hit India hard, and they either need to find alternative trading partners that they can do business with, or go back to the negotiating table with President Trump and give up something along the lines of agriculture or some other industries that they've been unwilling to budge on to this so far.
All right, Brendan, great to get caught up with you. Brendan Murray runs our global trade coverage for Bloomberg News out of London, and obviously we're going to keep in contact with him as this is never going to stop. Coming up, Kim Forrest of Bokeh Capital says the health of Nvidia's China business and demand for data center scaling is top of mind for traders today. She joins us to talk all about it next. This is Bloomberg Open Interest.
If you look at where we've been most recently, we've been at the tip top of we kind of broke through the top of the range. We're still pretty extreme. The valuations are still pretty extreme. So I think the whole market, frankly, is a bit vulnerable from a valuation perspective. But just the narrative has been so choppy. You know, can we sort of get the focus back on that AI narrative? That's really what I'm looking to see.
And that was RBC's Lori Calvasina on Bloomberg Brief this morning. Let's keep this conversation going now with Bokeh Capital founder and chief investment officer Kim Forrest. Kim, it's finally here. It's finally Nvidia earnings day. And we know it's not just about this one company. This is a market-wide event.
It really is, because it feels like for the past 18 months, absolutely any good news that has driven the market has been two letters, AI. And I think the build out of AI we've kind of assumed that, you know, data centers like Sherwin-Williams will cover the earth. And that's the paint company's slogan. Anyhow, yeah. But I mean, really, we think that there is absolutely no limit of the amount of chips demanded. And I think that's sort of foolish. And while I am a huge believer in AI, I also understand its limitations, and we're kind of bumping up a couple against them. And I worry that, you know, the fickle market will turn away from AI for a while.
Yeah, I am interested to hear you say that, because I was asking today and have been wondering if we risk developing some kind of indigestion with these hyperscalers spending, you know, $100 billion plus on CapEx. Don't we get to a point when they're like, all right, you know what, we have enough, and it doesn't matter that it's Blackwell or Rubin or whatever the next thing is, like, we don't need to continue buying $100 billion of chips per hyperscaler per year.
Right, and that is the law of large numbers, which we're bumping up against. I think it was excellent. I listened to the top of the show, and your panel on this was excellent about that. And just the growth rate, the crazy growth rate that Nvidia has experienced in the past 5 years can't continue for many reasons. You know, just the world will run out of money, essentially. I'm being glib about it, but I think this needs to, investors need to reset their expectations and maybe go a little soft on this, but we'll see about what investors think after today's earnings too.
And Kim, we only have about a minute left with you here, but it's something I wonder about even outside of the stock market. It's a conversation we were having the other day that you think about all this CapEx, all this money coming from the tech companies. You think about the economy ex-AI, perhaps it doesn't look as robust as it does right now.
And I think that is like a great time to actually look for great companies. If you don't think the economy is that robust, ostensibly, when the economy regains its footing or gets a little bit of forward momentum, which I think it can, there's always slowdowns and, you know, happening in any industry. It's a great time to go shopping right now, and I think that should refocus investors away from, you know, maybe trying to ride that momentum train called Nvidia.
The momentum train called Nvidia, that is a good place to put a pause in this. Kim, you are staying with us through the opening bell, just a couple minutes away. Let's take a look at the setup as we count down. And there's not too much to talk about. The S&P 500 off by about 0.1%. We did manage to build a rally into the close yesterday. We know that the main event is after the close today. You can see that the NASDAQ 100 down a little bit in anticipation. The Russell 2000 off by about 0.3% right now. We will walk you through all of the action at the opening bell coming up next. This is Open Interest.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, and it is Nvidia Day, although those earnings don't come out until after the bell. So this whole entire cash session is going to be super boring, just waiting for Romain to come on at 4 o'clock and for the close team to break the earnings. Futures down 0.1%, 0.2 on the NASDAQ. By the way, Nvidia is worth 8% plus of the S&P. It's worth more than 10% of the NASDAQ 100 and somehow 12% plus of the NASDAQ composite. Abbott Labs ringing. Wait, why is Brutus there?
I think it's...
That's my man.
It's mascot.
Ohio State University kicking off college football season this Saturday. Who are they playing, Joe? Texas. All right, we'll definitely win that game. That's very cool. Abbott Labs over the last 5 years, by the way, up about 30%, underperforming the S&P 500, but at least not losing money. And then down at the NASDAQ, we have Velo 3D. They were there. I swear to God, they were there. At least a couple of guys ringing the bell. And apparently they went public, I believe, by a SPAC on August 19th, because if you look at the chart, it's just down, 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 down. But they print out very cool metal stuff for rockets.
That's pretty cool.
Yeah.
And they were via SPAC. So SPACs are back. Let's talk about, though, Nvidia. That is the big focus of today, as Matt mentioned. It's priced to move 6% in either direction after it reports earnings after the bell. That is according to the options market. That is the lowest implied move in 2 years as traders focus on the staying power of the AI boom. Shares not doing too much right now, as you might expect. Matt, this is a company that is about 35% higher on a total return basis so far this year, obviously dragging the whole market up along with it.
All right, and by the way, over the last year, I think it was up 171%. The year before that, it was up like 235%. So obviously, it's just been a behemoth. A momentum. What did Kim call it?
Momentum train.
A momentum train. All right, we're going to watch shares of other Mag 7 companies as well, especially the big four, which are these hyperscalers that account for 40% of Nvidia's revenue. We're talking about these massive CapEx numbers. I think Google was $80 billion. Facebook is going to be over $100 billion. None of them doing much of anything right now because I guess like us, traders are waiting for the numbers to come out for. Let's get back to Kim Forrest, Chief Investment Officer at Bokeh Capital. And Kim, you have a background in software programming. You have a background in AI. What's your take on this whole thing? Because I feel like, you know, we've made so much momentum, and ChatGPT 5 is like so much lazier and slower than GPT 4. But eventually, or maybe that's how it gets more human. It's actually lazy now.
Well, I don't think they are human. I mean, I think we always lose our grip on what they are because they seem human to us, right? That the chatbot actually works more or less like, kind of like a friend. Ooh, kind of, well, I don't like that whole idea, but these are mathematical models. And what they're doing is they've kind of crushed, in a good way, the problem of natural language processing. That was a very hard problem that, as long as I've been a computer scientist, that's what my original degree, my bachelor's degree was in, it was a problem for computers to solve. And I believe that's really what ChatGPT and all of these large language models are doing, is they're able to understand us and then go and retrieve information or synthesize a little bit of information together. But again, mathematical models. So there are these holes in these models where it comes up with complete and utter nonsense. They call them hallucinations. And we must overcome this, or these models are really unusable. If you worked at Goldman Sachs as an entry-level person and were 85% right, I don't think you'd last very long there. But that's what these models are. They're 85 to 95% right. And you can't have that much wrong and still be a useful tool in enterprise. So this is the problem that they need to overcome. And guess what? It's a really hard problem.
Yeah, absolutely. One that, I mean, we'll have to check in on the timeline of how long that takes. But Kim, at 9:34 in the morning, I should probably ask you about how Nvidia interacts with some of the other cross currents in the market right now. You pull up a chart of the 2-year yield versus Nvidia. You can see that Nvidia has just pretty much steadily climbed higher since about May 1st, after that April low that it hit. You take a look at what the 2-year Treasury yield is doing, of course, moving off of what people expect the Fed to do. It's been dropping in that time. And, you know, the topic of rate cuts at the index level is an urgent conversation. But does it matter for a company like Nvidia? Does monetary policy really interact with what's going on with Nvidia's core businesses?
Absolutely not. They are completely divorced from any kind of tie to leverage, because the companies that are funding them, and you talked about this again in that A block, is that they have the cash to spend. That's the crazy thing. The 4 horsemen of the Mag 7 that actually are developing AI, they have the cash for this, so they don't have to borrow. Nobody cares. Not one person cares in those companies about what treasury rates are.
By the way, I have a viewer writing in who says each point move for Nvidia is $25 billion in market cap. So a 4-point move is the entire market cap of Intel.
Amazing. Which
I love. Kim, on that note, what's your take on the U.S. government buying a 10% stake in Intel, buying an $11 billion stake for $11 billion, essentially? Is that a good move? Do we need to for national security purposes, right? We don't want all the chip makers to be outside of the U.S. in case we get in a fight with everybody else. And what does it mean for Intel's business?
Well, a couple of things. First, I have to say this is going to be not a surprise to anybody that's ever listened to what I say. I'm a capitalist first and foremost. I am not fond of government intervention other than common sense regulation, whatever that means. Doesn't matter. We're not getting into that. Ownership of Intel at this point seems like not a great move, but not the catastrophe move either. The company has let itself decline. We all know that with respect to its fab technology. And it does have 75% of the chips it makes made here in the US. And you're right, it is an extremely important fact that, Taiwan, 60 miles off of mainland China, is where the world's most important chips are made. I don't think that's prudent. Forget the political ramifications. Just having one area in the world be that important, not smart. So I can see my way to this. What it's going to do for shareholders, I think shareholders are kind of demoted at this point, that it can be subject to its 10% or 9.99% owner, the US government, and it probably will be pushed to make decisions to improve its processing capabilities, match that of Taiwan Semi. Not bad, but it's going to have to speed that up to, answer its one big shareholder.
Absolutely, Kim. Have to leave it there. Always enjoy the conversation. That is Kim Forrest of Bokeh Capital. Meanwhile, let's get a check on the stock market right now. About 8 minutes into the trade on Nvidia earnings day, you can see it's pretty quiet at the index level, and interestingly, it's an even split pretty much when it comes to the ratio of gainers to losers right now. As you can see, up at the top, what's leading gains is Amazon, higher by about 0.4%. This is a big company we're talking about, though, so it's your biggest points contributor. Tesla, we haven't seen Tesla up here in a while. Tesla higher today, as is United Health and Salesforce as well, getting in the mix. But then you go to what isn't doing too hot, Nvidia, at the top there, only down about 0.5% as we anticipate earnings after the bell. You can see Broadcom also following it lower, as too is Meta Platforms and AMD. Let's take a look at the sector breakdown, how it shakes out there. I would imagine it's similar, of course, to what we were just looking at the individual level. Almost an even split when it comes to the sectors. Real estate up at the top right now, which is interesting, higher by about 0.5%. Energy, consumer discretionary, also higher as well. You take a look at the bottom, though, you do have tech down there. That Nvidia drop isn't going to help. Consumer staples and then materials is your biggest loser at the moment right now, Matt, lower by about 0.4%.
All right, so that's the setup as we await the big earnings announcement of the season, Nvidia. We're going to talk more about that next. The stock worth $4.3 trillion. Anton Chkaiban of New Street Technology Infrastructure joins us next to tell us where he thinks it's going from here. This is Bloomberg Open Interest.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Krispy Kreme getting downgraded to a sell over at JP Morgan, with the analyst citing execution risks for the donut maker's turnaround plan. Shares down more than 7%. Next up, we have Eli Lilly getting upgraded at HSBC after its obesity pill moved one step closer to approval. Now, after this upgrade, there's no firms with a sell rating on Eli Lilly. Almost a perfect score there, higher by about 0.6%. And finally, CLSA initiating coverage of Micron with a buy rating. The firm says that the memory chip maker is well positioned to benefit from demand. Remember, Matt, the stock is up nearly 40% year to date.
I had forgotten, but thank you for reminding me.
You're welcome.
Staying on chips here, Nvidia reports earnings today in a test of AI demand. Joining us now is Antoine Chkaiban, New Street Technology Infrastructure Analyst. And Antoine, as I said, this company, well, our last guest called it a momentum train. It's just been unstoppable, and the growth seems to know no bounds. What's your take on today's earnings report?
Yes, thanks, Matt, for having me. I think, a big focus is on China. As you know, there's been, a lot of news flow around Beijing trying to achieve self-sufficiency, Nvidia pausing again production for the H20. I think there's a lot of concerns around whether, China is going to be included in the guide, whether Nvidia is going to beat expectations. So, of course, there's one aspect related to that. I think, it's very hard to predict what's going to happen on that front. And I think it goes even beyond whether, China is going to get reassured on whether those chips have backdoors. There's been some reports that some China senior leaders found some comments insulting, So I think it's more, a negotiation between the US and China that's going to shape up what's going to happen next. And the bottom line is that China is probably going to continue to represent a source of volatility for GPU vendors. Now, I think 2025 is fairly well round up. So I don't, expect a major beat for Nvidia. I think, CapEx expectations now, make room for Nvidia. Like earlier, one of your colleagues talked about hyperscalers, who account for 40% of Nvidia's revenues. They make room for Nvidia now to meet these expectations. It's more 2026, the debate. So what I would really love to hear, from Jensen on the call is, some visibility that they get into next year, possibly even 27.
Well, it's interesting when you think about the call and sort of the messaging that might come from the C-suite. We were talking with Mandeep Singh of Bloomberg Intelligence. His expectations is that maybe they're going to de-emphasize China a little bit, focus more on the domestic market, given all of the uncertainties when it comes to the Chinese market and how, of course, trade policy and the relationship between those two nations will shake out. Is that your expectation as well?
Yes, Casey, I would say that's our expectation as well. I think there are much more important things to monitor than what's going to happen in China, and things where we can really build up a conviction. First one is how demand is shaping up. And in our view, it's still very, very strong. You still have these scaling laws. You have Elon Musk, tweeting that he expects to have like an installed base of 50 million H100 GPUs by the end of the decade. That's the kind of data points that matter to us. That's the where we think the debate is going to shift. There's of course the question of the defensibility of pricing power, how competitive dynamics are going to play out at the different layers of the AI supply chain, guys developing models, guys developing applications. So I think that's where the debate should be going.
You've done long-range modeling, and I wonder, how long Nvidia maintains this dominance. When I see a story like yesterday, AMD said it's going to work with IBM on quantum-centric supercomputers. I don't know what that is, but it sounds like they might get an edge there. How long does Nvidia rule the roost?
So quantum computers are still, a few years out. So I wouldn't call that, like a threat to Nvidia.
Antoine Jensen said still 15 years out. And then 2 weeks later, he's actually coming soon. So it seems like we're all over the shop in terms of when that's going to happen.
Yes, there's a lot of excitement, and I hope that they're going to come sooner than we think, because they're going to be very, very helpful, very useful, but they're not going to replace traditional computing to begin with. They're more going to complement it. And AMD building a strong position there, and by the way, they're not building only a strong position in quantum computing. AMD has a very good GPU. They're just gaining momentum. I just came out from a great chips conference here in Palo Alto, where all the developers were talking about how great, AMD software has become compared to a year ago. And that was one of the roadblocks that AMD had in order to gain adoption. So they've been working very hard with the largest customers to build, a software stack, a momentum, an ecosystem to be able to gain momentum. But that doesn't mean, that it's a major threat to Nvidia. I think, they're starting from almost zero, like less than 5% market share. I think even if you give AMD 10-15% share, which, in a context where Nvidia is probably going to remain dominant, they have much more resources to invest. You would still have, like a win-win situation where the market is going to diversify to AMD, to in-house programs, but Nvidia is still going to remain dominant in a very fast-growing market. So,
right.
We like the sector overall.
Well, Antoine, to that point, I'm taking a look at your notes. You write that when it comes to GPUs, you expect Nvidia to maintain 90% share in 2029, which is down from 96% today, but 90% share, 2029 is a long way away from here. How long do you expect them to maintain that sort of dominance? Does it ever get into the 80s, the 70s?
So this 90% share is if you look specifically at GPUs. If you look at the overall data center compute market, we actually, you don't have only GPUs. You have Google, for example, who's developing a TPU. You have Meta, who's ramping ASICs. Amazon, who also has ramped ASICs. Microsoft, who's trying, reportedly not doing very well. So if you include that part of the market as well, actually, Nvidia, the share that we're modeling for Nvidia is actually closer to 60-70%. It's just within GPUs, which is one category of the market where it's only AMD that they're playing, that we see them remaining, the dominant, because of course they have much more resources to invest. They have a head start. AMD just started, they're at like their third real generation GPU that they're ramping now. It took Nvidia like decades to get where they are today.
Right, yeah, good reminder, of course. This is a company that has been around for a long time. It's not an upstart new shot there. That is Antoine Chkaiban of New Street Research. Of course, Nvidia, like you have been mentioning, Matt, it only has one sell rating of the 80 or so analysts that Bloomberg tracks that covers it. So really, this is a stock that Wall Street loves.
Yeah, absolutely. 71 buy ratings, only 8 holds, and as you say, 1 sell. But the growth this year has been so much slower than the last 2 years, right? What do you say, 34% year to date? And that compares to 171% in 2024 and 238% in 2023. So
it's possible we've gotten a bit spoiled.
It is. If you look at the price earnings ratio, it actually holds steady with the exception of a big spike that we saw. Obviously, it's still very high, 57.7.
That's pretty high, but
it's not, Palantir.
Yeah, everything is relative. Coming up, more trouble for United Health as Bloomberg learns the Justice Department is investigating more than just its Medicare practices. We'll bring you the details next. This is Open Interest.
This is Bloomberg Open Interest. Quick check on stocks, and there are some sincere movers in this market, but at the index level, it's a whole lot of nothing. Absolutely unchanged, the S&P 500, though at 64.65 after yesterday's rally. We're only 3 points off of the all-time high. NASDAQ 100 trading down about 0.3%. That's interesting to see the tech stocks doing so much worse than the broader index. Let's figure out why. Join me as we look at these big stocks. Nvidia down 1%. It's worth a lot more on the NASDAQ than it is on the S&P. It's worth 12% of the larger composite versus 8% on the S&P. Taiwan Semiconductor down 1% as well. So chip stocks off as we await those earnings. MongoDB is up, making a Mongo move to the upside, 33% after a big earnings beat. Kohl's also up 24%. This is a pretty volatile market when Kohl's can move a quarter of its value in a day on earnings. Eli Lilly gaining about 1%, and we're continuing to focus on, or at least I'm continuing to focus on this obesity pill. Are the side effects really that bad? Did they last a long time? Do I just get through a couple minutes of it? All right, United Health Group is up, and that's the stock we're going to focus on, Katie, right now.
Absolutely, because Bloomberg has learned the Justice Department is investigating more than United Health's Medicare business as part of a criminal probe into the firm's operations. The company says it has full confidence in its practices. Bloomberg healthcare reporter John Tozzi, he helped break this news. He joins us now. So how broad is this probe?
So what we reported yesterday is that the Justice Department's criminal probe into United Health, which was known, ongoing, disclosed by the company last month, that it includes investigations into the company's pharmacy benefits unit, OptumRx, and that the Justice Department is looking at how the company pays its owned or affiliated physician practices.
So upcoding, we've only got 30 seconds, but how serious a problem is that? How expensive is it?
Yeah, so the understanding of this probe from earlier reporting was that it was focused on Medicare upcoding. I don't know that we have a real sense of the scale of that. We've seen other companies settle claims, some in the hundreds of millions of dollars. But the news here is really that the investigation is broader than was previously known.
All right, John, we're going to continue to follow your work. You can follow him on the Bloomberg terminal as well. John Tozzi covers healthcare for us. Coming up next, back to Nvidia. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Volume, as you would expect it, depressing right now because we're all waiting for the big event. And coming up, Wall Street gearing up for Nvidia, the world's most valuable company, takes the earnings spotlight after the bell today.
President Trump imposes a crushing 50% tariff on Indian goods, while Europe seeks to remove all tariffs from U.S. industrial goods this week.
Plus, another full bag of retail results, back-to-school demand, and celebrity partnerships helping to boost the bottom line.
All right, the stock to watch today is obviously Nvidia. Certainly after the bell, that's going to be the hot one. Last hour, we discussed what's at stake with Bokeh Capital's Kim Forrest.
We think that there is absolutely no limit of the amount of chips demanded. And I think that's sort of foolish. And while I am a huge believer in AI, I also understand its limitations. And we're kind of bumping up a couple against them. And I worry that, the fickle market will turn away from AI for a while.
Let's bring in Allspring Global Senior Portfolio Manager Margie Patel. And Margie, you were early on this trade, the Nvidia trade, on the chips trade. How do you see it now, having owned the assets for a while, having watched this incredible growth, this momentum train, as Kim Forrest called it? How has it progressed?
Well, I think it's still sustainable. And the real key is when we saw second quarter earnings to see the big investors in AI all continue to have capital expenditures that were as large or even larger than the market expected. So these leading companies still think that they want to invest in AI. The question is, will they at some point down the road say, oh, we're not getting a competitive return on those assets in AI? Will be an issue, but I don't think it's an issue over the near term. A lot of emotionalism in Nvidia because it's so widely owned. So the stock could move easily, 10% either way, no matter what the numbers are. But I think that it still should be one of the outperformers certainly over the next few years. Today, there's so much hope and enthusiasm in. Who knows how the market will react today? But the fundamentals for AI are still very strong.
Well, let's talk a little bit more about positioning, Margie, because you say this is a widely owned stock. There has been some hay made from the fact that you take a look at institutions and they're underweight, at least relative to the S&P 500 when it comes to Nvidia. I've heard that used as a bullish case for the stock going forward. I wonder how you see that.
Well, that's true that most funds don't own a statistically equal weighting. However, most investors have other internal rules for what percent they might own in a portfolio. So a large institutional investor might say, well, I don't care how great it is. Our limit is, say, 3% of our holdings or 4% or 5%. So I think a lot of investors simply underweight for that reason rather than feeling that they'd like to invest more if the stock pulled back or something like that. I think, and so much of it, too, is owned by short-term traders. So we have a lot of the short-term volatility, not from a long investor side, but rather from people looking for very short-term moves. And you can't really, sometimes it's pretty hard to tell the two apart.
Margie, you obviously you're managing an equity portfolio now, but you became famous as a bond fund manager, and you're always paying attention to how yields reconcile with stock valuations. And now we're looking at the 2-year yield considerably below the Fed funds rate. Does that encourage you to hold high multiple stocks? How does that story play along? We're looking at a chart, by the way, here with Nvidia, the S&P, I should say, just running higher as the 2-year yield, hits the lowest level since May.
Yeah. Well, I think that clearly the market wants and expect short-term rates should go lower because from 2 years to 7 years, everything on the Treasury curve is trading below the Fed funds rate. So I think it would be very appropriate. But really, when you look at equities, if you say, well, the earnings yield is Standard & Poor's is, call it roughly, say, 4.5%, more or less in line with Treasuries. But what's more important is what's happening to the profit margins and earnings growth on the equity side. And corporate profit margins have stayed very, very high, near the historic peak, which says that even though we have inflation, people concerned about inflation depressing margins, it just hasn't happened yet. And maybe that's why we see inflation above above what people are expecting, simply because companies have pricing power, maintain their margins. And to me, that's more important as to when the Fed will lower short rates. Clearly, that's important at the margin. That will help a couple sectors like housing. But we think the main bulk of corporate earnings are positioned to continue more or less in that 10 to 12% level they've been over the last few quarters, even with very muted economic growth.
Well, I want to focus this conversation on, of course, what's going on in the bond market and monetary policy back on the big tech giants, which, especially in the case of Nvidia, it feels like all these tech companies are just spending money on each other. We were having this conversation also with Kim Forrest, and she said Nvidia is entirely divorced from what's going on the monetary policy front. Is that an argument that you agree with? I mean, whether or not the Fed cuts rates by 24 basis points, is that going to affect the profit margins of a company such as Nvidia?
No, and I don't think that cutting short rates, although I think it would be good for the economy, has much of an effect in the whole tech sector, because really it's been driven by secular growth. Now it's AI, but there's still other parts of the economy that are increasingly using more technology, industrials, aerospace, defense, things like that. So we don't think that the tech sector is dependent. You're not looking at the tech sector as a PE, relating that to where interest rates are, but rather what's their growth rate, can they maintain the margins, what's the outlook. So I think that more importantly is the secular growth still there for technology? It looks like from what companies reported in the second quarter, the answer is yes. And it looks like we're still on that sustainable trend. A cut in rates would be nice, but it certainly isn't going to be what's going to be driving earnings on the tech side.
Do we hold it? I mean, I was surprised I think a lot of people were surprised at how well second quarter earnings did. If you look at the EA function on the Bloomberg terminal, you'll see 10% growth for the S&P. Do we hold, do we stay in that range? Is that sustainable, Margie?
Well, I think it is, because we've seen that for the last number of quarters where corporate earnings have come in 9, 10, 12% for the quarter, even though growth, the economic growth, has been much more moderate, 0.5% to 1.5%. And I think that's why you've seen the market divide into the slow growers who haven't had much positive movement, and so much money go to the fast-growing sector like technology, because in a slow growth market, that's where you want to be. But as I said, I look at profit margins, and companies seem to be able to maintain them. They seem to be able to have pricing power, which is very important for maintaining those margins. So we think that is going to continue. And I see no reason why we shouldn't see another quarter, third quarter that we are about to start finishing here, would be really the same type of thing, 8, 10, 12% corporate earnings, maybe a little bit more widespread, because we're starting to see more parts of the economy participate in a better economy. So you have to say the outlook for stocks looks pretty good, even if the Fed is sort of lagging on cutting short rates, which the market would like to see.
All right, Margie, that's a good place to leave it. Great to preview some of the action with you. That is Allspring Global Senior Portfolio Manager Margie Patel. Meanwhile, we are just almost 40 minutes into the session. Let's take a look at some of the individual movers on our radar. Database software company MongoDB soaring after raising its full year forecast, also reporting strong results. So a beat and a raise quarter, that's good for what, a 32% jump in shares.
I'm never going to get over the name. I will never ever get over it.
Nor should you.
It is hilarious.
It's
all right,
pretty funny.
Williams-Sonoma also boosting its outlook. It had strong results across all of its brands. That kept concerns of increased tariffs on imported furniture at bay, because Williams-Sonoma isn't just the kitchen stuff. They own
West Elm.
And what's the other one? Not Crate and Barrel.
Pottery Barn. Yeah.
Pottery Barn. So a couple of furniture stores in their portfolio, but the shares are off 1%. Maybe it was buy the rumor, sell the
Maybe something like that. Yeah. Let's talk about Canada Goose, though, because having a great day, the company's controlling shareholder has reportedly received take-private bids. CNBC reporting that these bids value the company at about $1.35 billion. That is roughly where the surge that you're seeing takes its market cap to, up about 16% right now.
You've never owned a Canada Goose coat, which
no.
I would say I'm surprised because they're so popular, but you tend to eschew the fads, don't you?
Yeah, I just don't really buy close, so I tend to miss all the trends that way.
It's also like $1,000.
Yeah.
For the,
yeah, I'm not going to do that.
For a black
I have to spend that on horses.
down coat. Coming up, from Travis Kelce to Bad Bunny, whatever that is, retailers are tapping star power to help fuel sales. That's next. This is Bloomberg Open Interest. Let's get now to high interest. Look what's making headlines around the world. Treasury Secretary Scott Bessent is calling for Fed Chair Jerome Powell to conduct an internal review of the central bank and saying mortgage fraud allegations about Fed board member Lisa Cook should be included in the probe. Meanwhile, Bloomberg opinion columnist and former New York Fed President Bill Dudley penned a column outlining his concerns about Fed independence. He writes, quote, "Markets are too complacent. Even if Trump stands only a small chance of taking control of the Fed, the effort itself is disruptive and the consequences of success would be dire." The Trump administration is reviewing options for exerting more influence over the Federal Reserve's 12 regional banks. The administration's goal is to scrutinize how regional presidents are vetted and chosen, as they are not Senate confirmed. The move would mark another step in Trump's ongoing campaign to influence monetary policy. Deal-making during the typically slow summer months has crossed the $1 trillion mark after a flurry of mergers and acquisitions. This month, there's no such thing as a merger. That's the highest tally since the record-breaking summer of 2021 when the pandemic sparked a deals boom. Some of the biggest deals so far: Union Pacific's agreement to buy Norfolk Southern and Palo Alto's planned purchase of CyberArk. There's always a buyer, there's always a seller. There's never a merger of equals. On the back of the buzzy American Eagle campaign with Sydney Sweeney, the retailer has nabbed Travis Kelce as its newest face. The drop is well-timed following Kelce's blockbuster engagement to pop sensation and billionaire and really once-in-a-century talent Taylor Swift.
Look at that ring. That is a rock.
Shares of American Eagle are spiking, but I mean, I guess it's really the engagement, it's the wedding that we want to talk about more than this 2.3% move. What do you think, Katie, as a lifelong fan?
I'm really happy for her. I'm not like a parasocial Swiftie, but I was certainly feeling genuine happiness when I saw the news yesterday. Congratulations, Taylor Swift. I know you're watching right now. There she is. Look at how happy they are. Looking forward to some of the photo ops there.
Good beard.
Let's get back to American Eagle, though, and basically the retail landscape in general, because Kohl's, Abercrombie, and PVH, the company behind brands like Calvin Klein, all out with results this morning. Mary Ross-Gilbert, senior retail analyst for Bloomberg Intelligence, joins us now. I won't ask you about the engagement, though I do want to keep talking about it. Let's talk about Kohl's, though, because Kohl's having a great morning. They were out with results. It looked like a beat and raise quarter, and this was needed good news for this company.
Yes, you're absolutely right, Katie. It's needed good news for Kohl's. You know, they're not out of the woods yet, right? Because their comp sales are still negative, and they're tracking against negative comp sales for the last 3 years for every quarter. And that means even going forward. But green shoots on the conference call. One, interim CEO Michael Bender came across very well, talking about the initiatives that, you know, some of the big initiatives, bringing back the private brands and the strength in sales that they're seeing there. And that's part of the margin improvement that you're seeing, better than expected. And as a result, their raise. Now, they ended the quarter with July comp sales flat and traffic up in the stores. Online did lead sales. So we're seeing some very encouraging signs there. And what we think is that not only with Kohl's, but some of these other retail brands are doing a good job in managing expectations with their guidance. And so we think it's the same for Kohl's for the second half. And we think they're already have a great start to the third quarter. And we think that the guidance that they put out, which still looks pretty weak with comp sales for the full year to be down, 4 to 5%, that there's a good chance that they can, blow through that. And I think that the stock reaction that you're seeing is part of it is the short covering, right? You know, they had been, the number of shares borrowed had been as much as 49% of shares outstanding. Now it's down around a third, but it's still, you know, about 5 days to cover. So, you know, I think that's some of the reaction. What is interesting with this Kohl's news, however, is that Bloomberg News yesterday reported an article that they were having discussions with some vendors about extending some of their terms, which is usually like a red flag. That never came up on the conference call this morning.
I'm looking through, MODL is like one of my favorite functions on the Bloomberg terminal. I'm looking through for Abercrombie and Fitch because, you know, speaking of expectations, they raised their sales forecast, but tariffs are eating into margins, and this is a company, let's see, cash flow from operations, it looks like it's coming down. So are they eating into their margins by not raising prices here?
No, I think if you look at Abercrombie and Fitch, actually, you know, for the third quarter, they did guide down for margins, you know, as a result of tariffs. And they did tell us that the net impact of tariffs is it's going to be about $90 million for the full year. But I think what's really going on is, one, when you look at what happened in the quarter, the decline in comp sales at Abercrombie were more than expected. And that was because they had some carryover inventory. So that means that their average price points were lower. They're hoping, they're indicating that, look, their inventory is in a better position for the brand. They've got great initiatives. Just like you talked about the Travis Kelce and American Eagle, they're going to be announcing some, you know, new campaigns and some collabs too. So that will be coming up, and they're very excited about how that brand can turn around. Hollister, meanwhile, is on fire with their comp sales up 19% and also a strong start for the third quarter. So I think with the tariff, as we get through the fourth quarter, I think margins should be okay, not impacted too badly because of tariffs and everything else. They've got tailwinds with regard to freight and that type of thing. So I think we'll see an improvement there. I would say that the tariff fear is turning out to be less of a hit than the fear that investors had earlier.
Well, Mary Ross, you brought up brand campaigns. That's exactly where I want to go. The topic of celebrity tie-ups for some of these companies. You think about American Eagle with Sydney Sweeney really causing a lot of discussion on social media, if you want to call it that. The president also weighing in on that. Then you think about Gap, for example, coming out with their own denim campaign. I'm sure on a certain level, all news is good news, but how do you think about that as an analyst covering these companies, how this sort of conversation factors into the bottom line?
I think it does factor into the bottom line, absolutely. And I'm glad you brought up the Gap campaign with Cat's Eye. When you look at that campaign, that came out last week. Within days, they had, 2 or 3 million views. It's now over 6 million views on that campaign. And if you look about their prior campaigns, which were also incredible campaigns, they didn't have that level of views. And I think what that's saying is that Gap is now back in the center of Gen Z and millennial minds, and actually across the age spectrum. So I think that when you look at the prospects for these brands and what they're doing, you just brought up PVH. They were out with numbers, same thing, beat and raise. And they have the new Hilfiger Racing Club bringing in Claudia Schiffer and Nicholas Hoult in there with their campaign. So it creates a lot of excitement. It's across social media, and that's really resonating with consumers. So I think these are very, very smart moves. Now, it also starts with the product. You've got to have great product, but we're also seeing that too, a real improvement in quality across most of these brands, and also great fashion and styles. And even Kohl's said, denim is doing really well for them, as it is for everyone, and it's the fashion denim. So that means the baggier fits, the loose, and the low slung.
Good genes are important. Mary Ross-Gilbert of Bloomberg Intelligence, thanks so much for joining us, talking about the earnings that were and those still to come in retail. Now, still ahead, the countdown to tech chip maker Nvidia earnings. Wall Street is conflicted about what to expect, particularly regarding revenue in China. That's really, I think, the big question mark. We'll talk more about it. This is Bloomberg Open Interest. Let's get a check on the stock market right now using the Move screen, which, as you know, is the most dynamic way of looking at really any index on the Bloomberg terminal. While I'm doing this, Katie, go ahead and check for me if this is an all-time high. Okay. 64.76. So we continue to trade higher and higher, and the breadth is good. 332 over 168. You can see the S&P just climbs into, well, maybe into the close, which is when Nvidia reports earnings. Nvidia not on the winning side. Microsoft, Apple, Google, Berkshire, Amazon, ServiceNow, all up here. Nvidia is the biggest point deduction, but it's only taking off at a loss of about 0.25%, 1.2 points. So not doing a lot. Everyone's waiting for the 4 o'clock earnings.
There you go. It looks like the intraday record high is 64.81. The record closing high is 64.68. So we'll see if these levels hold. Coming up, we're going to be talking about jewelry. Don't go anywhere. This is Open Interest.
You know, we put a 50% tariff on India on oil. You're going to see a lot more.
So this is a taste.
You're going to see a lot more. You're going to see so much secondary sanction.
That 50% tariff has kicked in with President Trump following through with his threat to secondary sanctions on India over the country's continued purchase of Russian oil. For more, we're joined by Bloomberg's Washington correspondent, Tyler Kendall. And Tyler, it's interesting to me that India seems to be caught between a rock and a hard place, right? Because obviously they don't want these massive tariffs. They're crushing to the Indian economy. On the other hand, they can't stop buying Russian oil, can they? They're, I wouldn't say addicted, but they need it.
Right, exactly. And we know that the discount on Russian oil has helped to fuel supplies in the growing economy, as well as keep domestic prices low for India. So our analysts at Bloomberg Economics have said that when India does the risk-reward calculation, there really is no confirmation that the U.S. would even give in to any trade concessions if they were to halt imports of Russian oil. So at this point, they're going to keep importing them. Another interesting factor here is that our analysts also say that this divide here when it comes to these stalled trade negotiations with India is likely to push the country closer to its fellow BRIC nations, including, of course, Russia, as we're talking about these imports, but also China, as we know that the Indian Prime Minister Modi is set to meet in China with Chinese President Xi Jinping on the sidelines of a security summit there just next week. So it is clear that they are trying to balance shifting alliances, perhaps, but also at the same time, India has been a really critical geopolitical alliance to the U.S. to counter China in that region. But at this point, Matt and Katie, it doesn't seem that enough concessions were really put on the table to help get this over the finish line. 50% tariffs, of course, doubling the 25% tariff that's been in place since August 7th, with that additional 25% tariff over their imports of Russian energy supplies.
Well, what does the dialogue between the two countries look like? Because you think about where we are right now, it's the 27th. We knew that a U.S. trade team was scheduled to arrive in India for a 6th round of trade talks between the 25th and the 29th.
Right, exactly. And that trip has appeared to be deferred, and we haven't even gotten an update at this point on when it's going to be rescheduled, not really marking too positive a development here as we try to wait to see if there are any sort of progress that can be made to bring those tariffs down. And we have to keep in mind, this marks a pretty stunning reversal for the country since it was long prioritized in these trade talks. In fact, you had the U.S. Treasury Secretary Scott Bessent in an interview this morning saying he himself was surprised by how these discussions have progressed. Keep in mind, Indian Prime Minister Modi was one of the first foreign leaders to visit the U.S. after President Trump's inauguration. They offered concessions pretty early on, including slashing tariffs on a range of U.S. goods, everything from luxury items to motorcycles. But if we've gleaned anything from these negotiations over the past few months, it's clear that the White House wants more than just to see tariff barriers dropped. And our reporting has indicated that perhaps some of India's more protectionist policies, particularly around market access for U.S. agricultural as well as dairy products, really does seem to have stalled these negotiations. And at this point, we haven't gotten an update on where those stand.
Absolutely, Tyler. Really appreciate your reporting on this fluid situation. That is Bloomberg's Washington correspondent, Tyler Kendall. Meanwhile, let's take a closer look at the impact of these tariffs on the jewelry business. India processes around 90% of the world's cut and polished diamonds by volume. Ankur Daga is the CEO and co-founder of Angara. Angara is a jewelry manufacturer and e-tailer with a large footprint in India, and specifically your major manufacturing facility is in India. So talk to us a little bit about how you're approaching and plan to navigate these levels.
Yeah, just for some context, so we manufacture out of Thailand, Los Angeles, and India. So India is one of three. The 50% tariffs is truly profound. It's something that we did not anticipate. Manufacturing centers, of course, take a long time to build. So for the U.S. market now, we are manufacturing all out of Thailand because that's incurs a 19% tariff as opposed to starting today a 50% tariff.
How can you be so nimble, Ankur? How is your supply chain set up that you can easily make such a switch?
We're relatively different in that we're completely vertically integrated. So we cut and polish a lot of our own gemstones that we buy from rough mines all over across the world. We design jewelry and manufacturing jewelry in-house in Thailand, India, and the US. And we also sell in the US, UK, Australia, and Canada. So we have some amount of flexibility of where we manufacture what and for which markets. So luckily, we're in a position where we can shift to Thailand. A lot of other retailers are not able to do so, and thus they'll be subject to the 50% tariffs that India will apply.
Interesting.
That US will apply on.
Put this into context for the overall business. I mean, outside of just Angara, as I said, I mean, you think about how important India is when it comes to the global jewelry market, specifically to the diamond market. I have to imagine that a lot of folks can't be as nimble here.
Yeah. So, diamonds tend to be on the wholesale and manufacturing side, very low margin, very high velocity, very high inventory turn. So a 50% tariff will upend the entire economics of the industry. This is something where expertise is really built over generations. So people in India have been doing this for many decades. Getting that skill set and moving that to other countries it's just very hard to do. Historically, there was zero import duty on loose diamonds from India to the US. So people used to import diamonds here and then manufacture in the US. That is no longer feasible because whether it's mounted in jewelry or coming loose, it will be dutiable now.
I want to just pull up a picture of Taylor Swift's diamond ring here, Ankur. I don't know if you've seen it. I imagine you have because this is your business, and it was like earth-shattering news yesterday. There it is, and Katie's guessing it's about 8 carats. Is that a guess?
It's pretty much a guess.
And I'm guessing it's not a lab-grown diamond. I would venture to say this is real, if not even antique. What do you think about the price here? Have you seen it? Can you speculate on the possible cost?
Yeah, gut is somewhere between $500,000 and $600,000. It looks like an elongated cushion cut, probably an old mine Golconda type 2A diamond. That's, again, just speculation, set in yellow gold. So, yeah, somewhere upwards of $500,000 would be my best guess.
Wow.
Interesting. I mean, you think about Taylor Swift's influence, and I think it's fair to call it that. We know that for younger generations, particularly Gen Z, they've been gravitating more towards the lab-grown diamonds. The fact that Taylor Swift's is not going with lab-grown here. She's going with a mined diamond. Do you think that will have any effect on demand from some of those younger generations?
Not necessarily. So I would say a couple of things. One is the 50% tariff on natural helps lab considerably because lab is a much cheaper price point. So lab diamonds trade at anywhere from 90 to 95% less than the natural equivalent. So even with the 50% tariff, it's still easier to absorb on lab. And second is what we've seen is with Gen Z specifically, a lot of the shift is happening to lab. So this last quarter, over half of engagement rings sold in the US had a lab-grown diamond, and that's up from 2% in 2018. So we don't see that trend reversing, and certainly not a lot of people can afford a $500,000 plus engagement ring.
Well, if his salary, I mean, first of all, it's not her choice necessarily, right?
What do you mean?
A lot of times the guy picks the ring, and it's a surprise.
I don't think so.
It was not a surprise? You think they planned this?
I think maybe she made a Pinterest board like a lot of other brides.
I would have thought maybe Travis, picked it out himself, and he makes a base salary of $4.5 million, roster bonus of 12.5. That's a workout bonus of like $250. I don't know.
I think that she had some
This is more than 2 months. This is less than 2 months' salary, is what I should say for him. So it makes sense. And I feel like she's worth it, Ankur.
Okay.
As are you. Great having you on the program. Thanks so much for joining us. Ankur Daga there of Angara, friend of the show. We love talking about diamonds, the lab-grown diamonds, and gold as well as it, hovers, sits almost going nowhere, a record high for the last, 6 months. Let's get a check on the markets right now. We do see the S&P moving firmly higher at 64.75. This would be a closing high. Katie mentioned the intraday high is like 64.81. The NASDAQ also putting up some gains, but not as strong, about 0.1% at 23,546. The 10-year yield also doing a heck of a lot of nothing, really. This is probably the most surprising to me, move, not at the 10s, but at the 2s, that you just don't see a lot of action in bonds, even as President Trump moves to fire Lisa Cook. He's trying to stack the Board of Governors. He's considering using more influence on the regional presidents. A Fed takeover should affect, I think, more of a move in the bond market, but it doesn't.
Absolutely, yeah. Didn't see a huge initial reaction to that news. I have to think that what people are waiting for, of course, are the PCE numbers on Friday. At least we will know that those numbers are solid, whereas when it comes to the removal of Fed governors, I mean, there's so many questions there. You could make yourself dizzy. Let's take a look at some of the single stocks moving this hour, though. Gold miner Newmont exploring plans to drive down costs that could lead to deep job cuts. Shares not moving that much, down about 0.7%.
J.M. Smucker struggling with sales in the last quarter as people pull back on buying coffee and snacks, or those things are more expensive and maybe more difficult to afford. And you can see Smucker's down 4.5%.
And we heard on the earnings call that company plans to hike coffee prices in the winter due to tariffs. So some bad news coming for coffee drinkers. Let's talk a little bit, though, about Cracker Barrel. The people have spoken, and Cracker Barrel pulled plans to change its logo after social media backlash, including from President Trump. This is really interesting. I mean, we've been talking so much about some of the campaigns by American Eagle, by Gap, and it really just goes to say that marketing matters. And with Cracker Barrel, this was a case where it was pretty much universal that people didn't like it.
Well, look at the Bud Light marketing issues, that destroyed its shelf position. With Cracker Barrel, I've only been in recently a Cracker Barrel that still looks the same as it always has. But I've heard from others that it's not just the logo. Some of the stores were actually remodeled to remove the charm and the traditional, Cracker Barrel vibes.
We need someone to do some on-the-ground reporting there. I will say that is one of the draws of Cracker Barrel, that you go in, every store is the same. You have all the tchotchkes, and then you have the restaurant over here. It's very comforting.
And the stock is up year to date, up 17% with today's move. But if you look at a comp chart, as we so often do, over the last 5 years, it's lost 43% of its value. So they have to do something, and that must have been what they were thinking when they changed their awesome logo to boring logo.
Well, as we were just discussing with Mary Ross-Gilbert, all news on some level is good news. So we'll see maybe if this publicity, even though it was kind of bad publicity, whether it reignites some interest in Cracker Barrel in terms of people actually showing up to eat there.
What did the president say? They've gotten $1 billion worth of free marketing from this?
Something like that, yeah. Anyway.
They need it.
It's been like 5 minutes since we talked about Nvidia, so we're going to get back to that. Nvidia's China sales are taking on a new level of complexity. We'll take a look at what investors are looking for next. This is Open Interest.
It goes even beyond whether China is going to get reassured on whether those chips have backdoors. There's been like some reports that some China senior leaders found some comments insulting. So I think it's more a negotiation between the US and China that's going to shape up what's going to happen next. And the bottom line is that China is probably going to continue to represent a source of volatility for GPU vendors.
That was Antoine Chkaiban of New Street Research speaking to us in the last hour. And for more on Nvidia, we welcome Bloomberg Equities Deputy Team Leader Carmen Reinecke. So Carmen, I'm taking a look at the story you have out on the Bloomberg terminal. You write that third quarter revenue projections for the company are roughly $15 billion apart. And I think that really tells the whole story.
Honestly, it does. This is a huge spread for Nvidia guidance, like estimates. Usually it's a much, much narrower range of what people expect them to say for the guidance going into the third quarter. And really the reason for this is this China revenue. So a lot of analysts on Wall Street have included some revenue in the third quarter for China in their estimates, but just as many haven't. So lining up the numbers once Nvidia reports might be a little bit difficult to see right away if they've met, beat, missed that third quarter guidance estimate. So we'll be watching for some volatility in the shares. I think that Nvidia will be very clear on what they're including and what they aren't. That's what they did the last time they reported earnings. But everybody is going to have to do sort of some quick math potentially to make their numbers align with that guidance.
I mean, I often write to Ed Ludlow or I message Ian King.
He's off this week, Ed Ludlow.
Yeah, well, but he still is covering Nvidia. And I asked them, how strong is a Chinese Communist Party warning to Chinese businesses, do not buy Nvidia H20 chips? Because they warned companies not to buy them earlier this year. I mean, months and months ago because of supposed energy concerns, right? And now they've done it again. And if I were a Chinese company and I got wind that the Communist Party didn't want me to do something, I would not do it.
Yeah, I mean, I think you're right. I think it is a very strong message to send to those companies. And we had reports earlier this week or last week, I can't quite remember, that Nvidia had halted some production of its H20 chips in China. So that could be a sign that they really just aren't seeing demand come back online. It could also be a sign that they are just moving forward through development of a new chip. There is the potential that they could have a version of their Blackwell chip rolled out in China. That's something obviously they would have to get another license for. And those revenues would be subject to the 15% tax. But that's something that investors are really going to be listening for more details on from Jensen Huang tonight. What is demand looking like for AI overall, right? Because Nvidia still is, above and beyond the leader in this space. But what is it looking like in China, and what are the plans there going forward?
Yeah, absolutely. Any clarity that we can hear from Jensen Huang on some of those points will be certainly market moving. But speaking of moving markets, it's interesting that you take a look at the options market, and Nvidia is priced for about a 6% swing either way, which when you think about how big this company, that certainly the company is, that is material to the broader market, but that's much lower than we've seen in previous quarters.
Yeah, so it has gotten more muted. I think especially in after hours trading, the initial swings that we're seeing on Nvidia's reports, and really what that is that so much good news is baked in here that traders have already sort of priced. They have their positions. We are 1% from a record high on shares of Nvidia. Clearly, people are feeling very bullish. So I think that the days of the 20% swing are sort of behind us, because it's going to be difficult for them to just completely blow a report out of the water. But that being said, a 6% move is hundreds of billions of dollars in market cap. This is the largest company in the world. It has the biggest weighting on the S&P 500 index. So what happens is going to affect the entire market.
All right, Carmen, thanks so much for joining us on this. Bloomberg's Carmen Reinecke covers stocks for Bloomberg. And
yeah,
when we come back.
Yeah?
This last 2 hours we've been saying, don't pay attention to anything else but Nvidia.
But
we're going to say forget about Nvidia. Bloomberg opinion columnist Jonathan Levin says you should be paying attention to Costco or paying attention to Walmart. He joins us next to explain why. This is Bloomberg Open Interest. Forget about Nvidia. Jonathan Levin of Bloomberg Opinion says Walmart and Costco's valuations are much scarier. He writes, in markets, the most painful sell-offs tend to involve things that people erroneously assume to be absolutely secure. I can't help but wonder whether the stocks of Walmart and Costco represent a similar sort of risk. Jonathan joins us now for more. And look, in the morning meeting today, somebody brought up Costco, and everybody's like, oh, I love it. Who doesn't love Costco? You know, it's so fun to shop there. But I'm looking at the Bloomberg terminal right now on the description page, and I see a PE of 53.5 for Costco. That seems insane, especially compared to Nvidia. When I pull up the PE there, it's only 58.4. So what gives?
Yeah, basically it is insane, in my opinion. You know, the story here is obviously pretty great, as it is pretty great for Walmart. These are companies that are seen as all-weather stocks. They do well when the economy does well, when the economy does poorly. And in recent years, they've seen growth sort of inflect higher. But the reality of it is these things don't have growth runways like an Nvidia is. You can't make the argument that their revenue potential is like a cajillion %, as some people will make that argument with AI stocks. They're earthly retail stocks, basically hemmed in by like the size of the American economy and the total wallet of American spenders. And so my argument is that like these stocks have basically become a classic safety paradox. More and more people have just wanted to buy them because of the perception that they never go down. Their earnings basically never go down, even in challenges like a pandemic or like Fed hikes and the sort of earnings recession of 2022. And their stocks are not very volatile at all. They deliver recently extraordinary returns with little volatility and minimal downside. So the temptation, which is always like a very, very risky temptation in financial markets, is to say, well, this has worked for the past 5 years, so let's just bid it up like crazy. And the valuations have now become a risk in and of themselves.
Well, let's talk about that a little bit, and we have just about a minute left here. You write that this perception of safety, it's inflated valuations. This puts them actually at a heightened risk of a correction. But you think about the size of these companies, they're big. I mean, Walmart has a market cap of about $766 billion, but they're not Nvidia big. So it's not like they're going to take down the whole market necessarily.
No, but I think if you were to see these stocks shudder, it would send a little bit of a shudder through the rest of the market, because in a way they've become emblematic of the momentum in this economy. They're the guys that are not supposed to falter ever, and if they were to do so, it would mean something for the rest of the market.
All right, Jonathan, I'm going to encourage people to go ahead and read your column on the terminal. You can type OPIN for Jonathan's work. You can see it on Bloomberg.com as well. Jonathan Levin, Bloomberg opinion columnist who covers markets and finance for us out of Miami.
Not bad.
Which must be awesome. Coming up, Wall Street reacts to Nvidia. We'll hear from analyst Vijay Rocky, strategist Marianne Bartels, and investor Joe Kaiser of Mercado tomorrow. This